All right, thanks everybody for joining us here. We will get kicked off with a couple housekeeping items first. Everyone's lines are muted upon entry. If you're having any technical difficulties, please send a chat to the event organizer. We will be recording and distributing the webinar after the event today. And lastly, the Q&A for today's session will be handled through the chat function on GoToWebinar. So if you have any questions, please feel free to IM them, and we'll do our best to save time at the end for some of those questions. If we don't happen to get to some of them, or if some of them even require more follow-up, we'll make sure that the team's able to connect with you. With that, I'll hand things over to the team so we can get started.
All right, Bethany, thanks so much. Good afternoon to all. My name is Leighton Smith, and I welcome you to the call, and we're looking forward very much to conversation today. I'll just reiterate, you've got the chat available for questions in particular, and we'll be weaving those into the conversation throughout. Don't hesitate to add others. So move forward to the agenda. You'll see after we introduce ourselves a little more properly, we'll start by talking about some of the details about what's happened in recent weeks, and presumably anyone on the call has a basic understanding, but we'll do our best to build that out a little more. Then we'll begin to interpret, and we'll talk a little bit about what this means for the economy, for capital markets, and as a result for investors, as well as for owners and managers in business. We'll talk particularly about what you might consider doing, as well as I said, answer questions throughout. So don't hesitate to chime in throughout, but we'll pause at the end also for additional questions. So with all that being said, let me introduce myself and then invite my two colleagues to do the same. My name is Leighton Smith. I'm fortunate to lead our business advisory efforts here at Bergen KDV. We help businesses to make plans for their future, to drive enterprise value, and ultimately, on occasion, to exit their businesses. We get a chance to work with folks in a lot of different industries. I'm located here in Eastern Iowa and move around in the world quite a bit. I'm born and raised farm kid in Western Iowa, and my life journey took me overseas and to the city, and I returned happily to a little more rural part of the world here in the Iowa City area. Professionally, I'm an attorney by background and worked in investment banking for a number of years before spending over a decade in the commercial banking area before coming here to the firm. I continue to serve as an adjunct professor at the University of Iowa, where I teach banking. So I've been involved and included here for that reason, I think, primarily. So it's a pleasure to join you today. David, would you tell us a little bit about yourself, and then we'll ask Eric to do the same.
Yeah, absolutely. I'm David Payton. I've been with Bergen KDV for about 7 years now. I work as a portfolio manager within our wealth management division. So mostly researching investments for our portfolio strategies, and sitting in on investment committee meetings and making decisions. So I'm based out of Cedar Falls, Iowa. We have a Waterloo office. I'm sitting at home right now. My life right now is consumed by two children under the age of 3. So that's basically what I do with my free time.
Thanks, David. And Eric, welcome. Thanks so much for joining us. Tell us a little bit about yourself.
Yeah, my pleasure. Eric Anderson. I'm actually with BMO Harris Bank, based out of Minneapolis. I am in the Treasury Management Group that supports our commercial banking efforts throughout the Midwest. And I've been with the organization about 25 years, about 20 of those years within the Treasury Management area. So we're working with customers quite a bit on depository services and other Treasury products that they may need. My kids, thankfully, are out of the house. I've just got a couple of dogs that keep me busy, and that's a lot easier than what David's going through. So.
Well, thank you, and welcome again. So just for the benefit of the audience, I'll facilitate and add some color commentary every once in a while. David will primarily speak to you as an investor and depositor from a capital markets perspective, since he manages money for a living. And Eric's going to tell us more about what's happening in the banking industry, as well as what it might mean for a business owner and how they engage their banking relationship. So thank you again, gentlemen, for joining us. So some things happened recently, right? And I think everyone on the call probably understands that there were Series 3 bank failures that happen in the United States, as well as one in Europe, and the interconnectedness of everything, as well as I think some of the advances in technology, as well as overall economic environment, has caused this, like is always the case when you have challenges, to be a hot topic, right? And so some of the questions that I know you all are wondering about are represented here in some of the articles that we've grabbed. What does this mean for the economy, right? What does it mean for the banking industry? Is this contagious, as it were? And so we're going to speak to that a little bit. But just to begin, Eric, would you just talk a little bit about what's happened and establish some baseline of facts, maybe before we proceed with interpretation?
Yeah, I think I think for the most part, what we've seen is more of a issue with bank management and concentration. I think to a large degree, there's been a lot of concern about contagion across the industry, and certainly when you have some bank failures, it does tend to force folks to look a little closer at other institutions as well. But I think, and we can probably get into this a little bit later as well, but I think for the most part, Silicon Valley, for example, didn't fail because of bad loans. They failed because of questionable management and concentration, and then in the end, liquidity, which is always paramount for institutions and businesses as well. So, yeah.
Say a little more about management and what you mean by that, if you would. What were some of the root causes?
I could probably speak more to the Silicon Valley Bank. I'm not as familiar with some of the management issues at the other institutions other than Credit Suisse. Credit Suisse has kind of been a basket case for years. But, I think if you look at Silicon Valley Bank, they were without a chief risk officer. They were without a permanent CFO for a good number of months. Some of the information that I've been reading is that, the regulators had put them on notice. They had written memorandums of understanding to them to correct deficiencies, and that the bank was just dragging its feet on getting some of that stuff done. And I think as well, there's been a lot of discussion about their investment portfolio, and I think the way that was handled was to manage more for short-term profitability than it was for long-term stability. And so I think you can lay a lot of those problems at the feet of management of that institution. Like I said, the regulators did have some memorandums in place to have them correct the problem. You can probably blame regulators for not acting quicker to enforce those types of things. But it's a bit of a balancing game as well. As from a regulatory standpoint, you really don't want to step in unless you absolutely positively have to, and that's what happened here when all of a sudden there was a liquidity issue and a run on the bank with some of their larger depositors. And again, concentration came back to bite them. It was concentration of very large depositors and primarily tech and investment type depositors.
Great. Well, as we move forward a slide here and continue to discuss, say a little more about what those causes ultimately look like. You spoke to management here, but say more about concentration. What causes, if you want to, a bank to fail generally, right? It always ends as a liquidity issue, to your point.
Yeah, exactly.
How does it begin, and what causes a challenging environment?
Yeah, one of the things that has been highlighted especially with Silicon Valley, is that they had a fairly large bond portfolio that was held to maturity and not marked to market, and so they had a significant amount of unrealized losses on the books. Those bonds were all at very low rates, and so that was a combination of things. When interest rates have taken off the way they have, as you can see in the chart, the Fed funds rate, target Fed funds rate, has increased significantly here as the Fed has been kind of fighting inflation. And with the bond portfolio of 1% and normalized rates up around the 4 or 5% range, there's a significant unrealized loss in that portfolio. And if they would have been marking to market, it would have been much more transparent, but they would have also been showing probably some significant losses in the current periods or the recent periods. And so I think, you kind of get to an inflection point where, management had no choice but to start liquidating those bonds at really significant losses to try to cover the run on the bank, and that's when the FDIC had to step in. So that those depressed asset values really kind of came back to bite them at that point in time. And then the concentration issues, the Silicon Valley obviously has been known for a long, since its inception of a tech-friendly institution, and they were very good in that space. Concentration doesn't necessarily mean it's a bad bank. It just has to be managed properly. I mean, we certainly have concentrations with banks around the country that have, concentrations in real estate or concentrations in agriculture, things like that. As long as you can manage the risk properly, you can manage through some concentration issues. And again, we can probably touch on this a little bit later, but I think one of the things to look for, with your banking partners is how diversified is their loan portfolio, how diversified is their deposit base, et cetera. Excuse me. And then there's the bank in San Diego, and I think Signature Bank to a degree. They had some concentration with crypto, which is, has been having some significant issues over the last several years as well. And as those types of companies were struggling and filing bankruptcy, those institutions were kind of feeling the brunt of that as well.
Right. Well, thank you for that. I think at the simplest level, banks like stable interest rates, right? And when there are dramatic fast changes, that management skill that you were referring to earlier gets tested, right? And
it's been a challenge.
Are revealed.
Yeah, it's been a challenge for us, in working with clients directly, and then trying to balance that against what kind of our corporate finance team is looking at, from trying to balance our balance sheet, so to speak, asset and liability management on how much do we pay to be competitive, but how much is too much, and being careful about concentrations with really large depositors as well. We will, in many cases, we're not going to take unlimited amounts of deposits from certain clients. We're going to cap them at certain levels as well, so that we're not overly weighted on just a handful of clients. And I think that's, most banks are going to be looking at that kind of strategy as well. And one of the bullet points here of how contagious is it? I don't get the sense that it's overly contagious right now. I think that there's a significant amount of focus, obviously, but I don't see it spreading much more. I think we would have seen more collapse, like First Republic, for example, another bank in California that's, again, more high tech and some crypto as well. And it's other banks and the Fed have stepped in to kind of prop them up a little bit and kind of get them through the hard part. I think have fallen. I think you could have seen a couple of other regionals that would have had some trouble as well. But I think, knock on wood, I think we're through the worst of it right now.
Yeah, and I tend to agree. I think your point about mark to market as opposed to hold to maturity is, one of the things that I've spoken to on this. It's relatively unusual, right? Or particularly for that scale of bank, that would be a very sort of
for as much of the portfolio. I mean, all banks will have some, hold to maturity versus mark to market, but I think the percentage that they had was unusually high.
Yeah, exactly. So that to me is a key distinction that I would make. On the other side of the spectrum, on contagion, I think one of the things that's been talked about that's interesting and I think valid is, with access to transactions on mobile technology as opposed to going into the bank physically or something like that, and sort of the idea of a scare and what that might do and so forth. I think what's happened so far is every banker in these United States has had a conversation with every client in the last 30 to 60 days. And yet I don't think a lot of people have made a lot of changes, but I don't know how to calculate for that personally, just the speed of transaction and what that means. I think there is some systemic risk in society based on that today, but that's really no different than we're used to in capital markets in a sense, I guess. So it's
they're saying the first run on the bank via Twitter, right? So it's kind of different.
Exactly. So as we proceed forward here, um, just for some more context here, I think, scaling or sizing this, right? How bad is this, right? I guess is sort of the question.
Yeah, and I think to my point earlier, I mean, we've had a couple of banks that have failed here, but if you look at it in context, obviously the Great Depression, there was a significant number of banks that failed. There's a lot more banks in the market today than there was back then. You look in the late 80s and the early 90s, you've had kind of the S&L crisis. Again, that was primarily driven by savings loan institutions that would rely on short-term deposits, but then they would write 10, 20, 30-year mortgages on different types of properties. And when the mortgage or when the real estate market would contract, then they would have a significant problem there with not being able to collect enough on these loans and on these properties to be able to cover their short-term deposits. So that's where you saw a significant spike back then. And then again, obviously in 2010 timeframe, right in there during the Great Recession, there was a little more broad-based type of failure. But again, it was a lot of real estate. There was a really kind of a real estate boom and bust through that period. And so, institutions, again, that were pretty heavily reliant on real estate were kind of pummeled pretty good. But, since that time period, it's been relatively minor. And I think, there have been some bank failures. Most of them are going to be small institutions. And most of the time, the FDIC can step in and very quickly turn around over a weekend and sell those banks to a local competitor. And, it's a little bit different the last time around. That Signature Bank out in New York recently here, again, that was acquired by another bank. Silicon Valley, it took a little while for them to get another suitor in there. Part of the problem was that failure was a little unusual in that the FDIC stepped in and kind of closed the middle of the day because they couldn't. I mean, there was so much money flowing out the door, they couldn't value the company or the kind of the holding company because of the value was changing every second. So.
And if I could just jump in and add one thing, I know the media likes headlines, and I think part of this is their comparison to 2008 of saying SVB is the largest bank to fail since 2008. I think we had to look deeper beyond that to say, well, SVB's size in relation to the rest of the industry was not like WAMU's size to the rest of the industry in 2008. So yes, in an absolute sense, the amount of assets that Silicon Valley Bank had and their size was significant, but in relation to the rest of the industry, and that was 15 years ago, it's a much different dynamic.
Yeah, I think it's a point well made for people who wouldn't have a reason to follow the banking industry closely. Just for frame of reference, there are approximately 5,000 banks doing business in the United States. And a typical, I mean, you're seeing this bar chart here to see how few, but I mean, it's literally a handful that are failing. But probably what's not visualized in a chart like this is some of the momentum behind mergers and acquisitions in banking. There's enormous consolidation. There are a number of banks that don't have the growth power or financial strength to probably continue to do business for the next generation, right? There's a lot of consolidation happening in the industry, and so where you have banks of size that have risk like this, if it's not fraud, it would be something like I think you referred to, Eric, in mismanagement. So, David, that reference to the size and scale, I think, is a really useful one. So we're kind of spoken to this already in terms of differentiating between the two. Dave, would you say a little more about the overall economy and marketplace right now? You want to speak first you want to pull out your crystal ball, please, and speak a little bit to interest rates and what this might mean. Then Eric, if you want to comment on that too, I obviously welcome it.
Yeah, we don't love to predict markets. We think it's kind of a fruitless exercise, but we can certainly give our opinion on what we think. I think there's certainly there's a lot of uncertainty in the market right now, facing high interest rates, potential recession coming, high inflation, the Fed reducing its balance sheet. If you want to throw in the debt ceiling approaching, slowing earnings, likely slowing growth, slowing demand. So it certainly isn't, it doesn't seem supportive of financial markets at the moment. We're likely going to see, I think one of the biggest impacts from the failure of SVB is, and other banks is, further tightening credit conditions. We were already seeing this, but I think it's going to accelerate even more. I think this also increases and kind of pulls forward the likelihood of a recession this year. We've already heard from the Fed they believe a recession is going to start later this year. And as it relates to interest rates, immediately following the failure of SVB, we saw the futures market dramatically price in lower rates for the rest of this year and next year from the Fed. But the Fed has stayed where, as far as their dot plot goes, they've stayed where they've been. And so, that difference could create some volatility as the market tries to, understand what the Fed might do. I think the Fed's to some degree got their foot in both camps. They're saying there's a recession on the horizon. In that sort of scenario, you might expect the Fed to cut rates, but at the same time, their dot plot says they're going to hold through the year. So that obviously gives them some leeway, but they're to some degree got a foot in both camps. I think the upcoming meeting we're probably going to see, according to probabilities in the futures market, we're probably going to see another 25 basis points coming up. And so, as far as our positioning within our portfolios for our clients, we've had a cautious outlook kind of throughout last year and into this year. We've maintained that positioning. Because of all the uncertainty, we think, it wouldn't be unlikely or wouldn't be unreasonable to expect more volatility in equity markets and maybe another sell-off. If you look at past recessions and earnings decline during those recessions, if you assume maybe a 20% earnings decline, and you look at the forward multiple of, say, the S&P 500 right now, you can get anywhere from a mid-teens to mid-20s% sell-off. I'm not saying that's going to happen, but just backing the forward multiple off and potential earnings decline, that isn't all that unreasonable. At the same time, if we do hit a recession and the Fed does cut rates, I think the market would embrace that. So that would certainly be a catalyst. However, I think the path to lower rates once we do hit a recession is going to be slower and more measured than the path higher. I think Eric, as you or Leighton, I forget which one of you mentioned earlier, the dramatic rise in interest rates. If you look back at certainly the past few, maybe beyond that, interest rate hiking cycles, the current one is by far the steepest and quickest that we've seen. And I don't think the path lower, on the backside of a recession would be the same.
Right. And so one of the questions we had from the attendees was, what our sense of how long the interest rate environment will remain, quote unquote, high, which is obviously a relative term in short-term context. But I'm hearing you say, and I agree, that the decline, if there were one in interest rates, would be much more gradual than the workup. And so as to whether or not to invest in other things, equities, for instance, obviously that's situational to the investor, but can you say anything more about what we're doing with cash in portfolios right now? We'll get to FD's coverage limits in a minute, but what are you doing with liquidity in the short term?
Yeah, kind of our general philosophy, really in any environment, is if you've got cash needs, even out to 2 years, keep it in something that, like a CD or a treasury bond that's going to mature, kick off an interest payment. It's going to mature. You're going to get your principal back. Don't go taking, especially equity market risk. If you have a defined use for that cash in the near term.
Sure. Well, I would just say relative to future banking issues, what we can speculate about. I think one of the questions someone had asked in here, what we see happening with FDIC coverage limits. Nothing's happened yet. It's a hot topic, right? Just for historic context, I believe it was 2008 that numbers went from 100 to 250,000. And I believe it was a generation since it had gone to 100. Was it 1980, Eric, or what year was it?
Yeah, I think you're right. Move like
Yeah.
25,000 up to 100,000, something like that. So
Right. So even setting it a bit in context, these aren't things that are automatically adjusted for inflation. So when originally imagined, this was designed to protect the nest egg, of a middle class family, right? And so, there's dialogue right now in the congressional setting of increasing this to 2, 5, as much as $10 million. I think goes without saying, offsetting any systemic risk for runs on the bank based on public fear would be much more valuable to society than the small amount of losses that might be reinsured by FDIC. So it'll be interesting to see what's going to happen there. I'd say that's a question of political will and interests. I don't know what to predict. I don't know if either of you has comments on that, what you think will happen with coverage limits.
I'm not convinced they're going to raise it. I think it's possible. I have not heard much on it though recently. I think you're right. The FDIC insurance was really developed with the consumer in mind, and especially with the Silicon Valley run, that was all big business that they were trying to protect. So a $250,000 limit for most businesses of any size really doesn't do a whole lot. But I think the FDIC kind of looks at it as like, we're here to protect, like you said, the nest egg of a middle class family. And we expect businesses to do due diligence with their partners and look at, counterparty risk and things like that. And that's frankly some of the conversations I've been having with clients over the last several weeks as well. Just kind of making sure that they're looking at the right things when they're looking at their banking partners and determining counterparty risk on their balances.
Yeah. There's an astute question here in the chat you might see, but I'll read for the group. It's asking, it's noting that deposits have been declining for over a year, and actually generationally, right? We've been saving less as a society, right? And so back to that asset liability management that you were mentioning earlier, Eric, right? Because banks, if they're going to make loans, can either get it from depositors or they can borrow the money themselves to reloan it. And I think it goes without saying, generally you've got more interest margin when you're using deposits, right? And so it's been a competitive environment.
Yeah, banks are still very hungry for deposits. You've seen that as rates have continued to creep up and the banking world trying to compete with, off balance sheet money market funds and things like that. A situation like we've experienced here the last couple of weeks, I think I read that there's been like $30 billion that's moved out of deposits over the last couple of weeks into, government and treasury type funds and prime funds. So there is definitely a little bit of more than a little bit of people that are spooked and kind of a flight to safety, so to speak, or a little bit more diversification. And that is, causing banks, I think, to continue to raise depository rates a little bit further to try to maintain deposits to be able to lend out rather than going out to the institutional markets for deposits and generating cash for lending. And then it's kind of a little bit of a vicious cycle. Then now that also drives up lending rates as well. So which we have seen. So
yeah. And I think the question was suggesting the banks haven't repriced properly or as quickly as they should. And I don't know that I disagree, but from an investor perspective, what are the trade-offs to traditional core deposits versus insured cash sweep accounts or other liquid-like housing places for value? What do you see as the trade-offs? Maybe David, if you want to speak to that first. If someone moved their money out of a CD into some sort of insured sweep account, beyond the basics of, for an individual, diversifying into multiple banks for FDIC coverage, which is, a strategy that people can deploy. What are other options and what are the trade-offs for cash?
I'd say, the most obvious trade-off for cash would probably be treasury securities. Depending on the maturity that you're investing in, you're going to be susceptible to price swings there. And so, yeah, I'm not, that's the most obvious trade-off. I'm not sure, early,
I think
beginning part of your question, I'm not sure I'm well
I don't know
versed
if
in
I
that.
asked it well. I mean, to me, I don't know there's a sophisticated answer here to the question asker. To me, you're asking, is there any downside? I mean, it's simply cost, right? I mean, is one of the material downsides. Now, depending on the amount of liquidity that you're depositing and so forth, does it make sense to go around in person or virtually to multiple or dozen versus, leveraging that kind of platform? That's probably a personal question. Are there any other downsides to utilizing the kind of programs like that banks are offering today?
I guess I can speak to that a little bit. I think, if I think it's a very conservative posture to kind of diversify out and put 250,000 all over the place. If you're a borrowing customer from your bank, some of the lending pricing will be based on the overall profitability of the relationship. And so, I mean, I think if you historically have kept fairly sizable deposits and then all of a sudden you move your deposits, that's part of the formula when it comes to overall pricing your relationship. So that is something to be at least cognizant of. There is the hassle of going to different institutions as well. There are banks that do offer, CDARS programs or some other insured type products, which are pretty popular. I think from a business perspective, I think as long as the service can be managed easily. I'm not as familiar with those programs. We don't actually offer that at BMO, but I think as long as it can be managed easily by the customer, there's nothing wrong with those types of products. The one thing to remember though is that you are moving money out to a number of different institutions that are FDIC insured. That protects your money. It doesn't necessarily give you liquidity. So, for example, if one of the banks where those excess funds is residing would fail, it could be a little bit of time before you could get your money back out of there. It would be protected, but there is some risk as well, just from a liquidity standpoint. So I always like to tell customers that, go ahead and invest, go ahead and move money into some other longer term or safer type instruments if you so desire, but just make sure you have sufficient liquidity either through cash on hand or through available lines of credit so that you can continue to operate in the short term 3 to 6 month range.
Yeah, I think let's spend another minute in that area. I mean, you're speaking to the relationship philosophy that banks have. So, I think if yes, et cetera, I'll just say as the non-banker and force Eric to say it, right, that, building off of what you were saying, Eric, about the pricing strategy, probably should be said here that if you're a borrower, right, the price of your loan is certainly impacted by whether or not you're a depositor. And I think that's more true than it's ever been, at least in my lifetime, given the scarcity of deposits. So everyone's got to do their own math about the probability of risk on deposits at an FDIC insured organization. But if you have an extremely small chance of there being an issue or a problem, and you've got, say, a 25 basis point uptick in the cost of money to you that you're borrowing, to me, that's the math that you're doing in the trade-off. So how essential liquidity is, how much it is, I mean, these are person-specific or business-specific matters, but relationship pricing is absolutely real. Banks more than ever are focused on wallet share and cross-selling. The average percentage of revenue coming from something other than margin spread on lending is more than doubled in a generation. So, banks might have had 10 or 15% of revenues coming from other areas. Now they're often in excess of a third or half. This is very much a question of how large a bank is. The larger the bank, the more fee income and other sources of revenue they have. But net interest margin has been as compressed as it possibly can be from a decades long, extremely low interest rate environment. And so there's no free lunch, in other words, right? And so my answer to a client, if I were talking to her, would be, to really look specifically at what other needs she has from the bank and have a frank conversation about what that relationship pricing is. This question on diversifying relationships, whether in banking or other, I think it'd be disingenuous to say that it's not a good idea to keep any business relationship honest by exploring options.
Yeah.
But there's absolutely pricing advantages, as well as, I think, just relationship health and strategic insight that comes from having a heavy consolidation, if not a singular banking relationship that you're working with. So people that treat banks like an arm's length vendor in a pricing way are certainly less likely to get the best advice possible, simply because the bank can't understand or have full optics to what's going on in the business. So my personal answer would be that, is there reason to diversify deposits in order to maximize FDIC insurance? Sure, absolutely. And as we already discussed, one can do that by going physically or virtually around to all those, or by using some sort of solution that some banks do to do that from within their own platform. The amount of risk to that depends on the person and et cetera. I don't personally think that we've seen a massive systemic shift in the risk of core deposits at banks in the United States. And I would just say, personally, I'm not personally diversifying banking relationships as a result of the recent past, and that's probably the most honest, direct thing I can say about it. So, but if you have everything that you own and that you borrow entirely in one institution, i.e., you don't even have a diversified investment portfolio, and everything that you have is in deposits in a bank, yeah, you should probably look at options. I doubt very much there are many people on this call that don't have diversified investment portfolios. So that would be my answer. Eric, what would you say about that, and or just how does one go about evaluating their banking relationship?
Well, I think, I guess you could look at this a couple different ways. I mean, are you, from a pure relationship standpoint, are you getting, are you working with your banker? Are you getting good advice from your banker? Can you have an open and honest conversation with your banker about, diversification and risk, et cetera? And then I think if you look at it more globally, just looking at kind of the risk inherent with banks, obviously, larger banks are going to have, S&P or Moody's type ratings and some statistics around their financials that you can pretty easily get to evaluate, an institution. FDIC website has some ratings as well. Morningstar is another one. There's a couple of other more private rating agencies that probably will charge you, but they do provide some. They'll take FDIC reporting and then kind of break it down and give you some kind of a risk profiles as well related to different institutions if you're concerned about that. So, and then I think the other item you have here is how to allocate cash. And when I talk to clients, we kind of put it into 3 buckets: short-term operating needs, intermediate cash, and then long-term strategic type cash. And obviously your operating cash you're going to want to keep in deposits or in highly liquid instruments that you can get access to on a pretty quick basis. More of the intermediate stuff, would be something along the lines of what David maybe talked about, which would be, some fixed term type treasuries or something like that as well. And then, strategic or longer term project type stuff, maybe the same. But, kind of the world I dwell in is pretty much all the short term liquidity. I don't really get into any of the longer term type instruments. Most of the things I'm dealing with customers on is, their short term bucket of cash. So, David, I don't know if you've got more comments on that either.
No, we take the same same perspective on the three buckets. And we're actually, from my perspective, we're actually on the longer. That's kind of what we do for institutions, is we can develop a strategy for some of that long-term cash that doesn't have immediate needs, as we can put together some type of investment portfolio that suits their needs.
Gentlemen, we had a couple of industry specific questions, and I don't know if you have any comments, but we had a question about how this and the overall economic environment might impact the healthcare industry. Then we also had a question about the impact on land values in an agricultural setting as a result of this. So rising interest rates and economic distress, what do they mean for those two industries, if you have any thoughts?
I don't have a lot of exposure in my client base to the ag industry, so I probably can't speak too much to that. I have a few healthcare clients. One of the things that they've had some concerns about, obviously coming out of COVID, they were getting more reimbursement, for those types of patients. However, their costs were skyrocketing because they were all hiring traveling nurses, and trying to get help was significantly hard. What we've seen kind of as we come out of the COVID environment is more, in Minneapolis here, we were right on the eve of a very large nurses strike. There was a fairly large increase to salaries for the nurses across the hospital systems here in the metro area, and which frankly they probably deserved, but it does eat into the or provided a significant increase in cost to the healthcare systems and the healthcare providers. And the thing to remember is, hospital systems and healthcare providers have, they have contracted with the insurers for fixed amount of reimbursement on certain services, and those contracts tend to run, 3 to 5 years sometimes. And so their revenue is kind of locked in, and their expenses are going up. So they're going to feel a pinch here, and it's going to be, I think, a little bit more difficult time in the healthcare field for, especially for hospitals and some of the larger medical systems.
Well, I would just comment from an agricultural standpoint. There's a question about any implications for rent or land values. I mean, I think the logic of it is that higher rates for cash should mean that landowners have other alternatives that are more attractive. My personal opinion is that land ownership in the agricultural setting, at least in the Midwest in the United States, probably the other factors are profoundly more substantial than short-term interest rate changes, namely baby boomer generational transition of wealth and high farm incomes in the very recent past. If farm incomes were substantially depressed, and if interest rates remained relatively high, again, this is all a matter of perspective, depending on if you're thinking generationally or in the last 5 years. But if I were renting farmland, I would not be concerned about short-term decreases in rent as a result of interest rates, in contrast to the boom that's still there for demand. Now, will farmland decrease in value? I mean, of course, none of us has a crystal ball, right? But I think the tailwinds of interest in that from generational wealth, everything I'm reading is that still anticipating increases, at least in the short term, right? And so, and as I'm sure you know, as a person who rents land, those things are typically negotiated annually. You heard David say that anticipate economic distress in the fall. So when it comes time to cancel leases and renegotiate, it'd be a little more interesting than a year ago, but I think there's still an enormous amount of demand from producers to rent land. And interest, if anything, rising interest rates mean that land hungry producers are going to have a harder time buying land. So there may actually be more demand for rental, would be my perspective on that question. So there's nothing else on industry specific things. Why don't we, more great questions here. You guys want to speculate a little bit on what Congress is going to do? So what could be the impact to cash management if Congress can't reach an agreement on the debt ceiling, what might happen to the economy if they're not able to do so? And specifically, person asked, will T-bills be available?
I don't know.
I mean,
Go ahead.
from an
You go first.
from an economic perspective, I mean, if there's if they don't reach an agreement, there's going to likely either be a prioritization of payments, which some people's, disagree on whether that would happen or not, or just an outright no payment on, things like Social Security payments, government contractor payments, stuff like that. So frankly, that would just, from a general sense, just be additive to a slowdown in the economy if those people aren't getting paid. Think of Social Security payments are essentially income to those receivers, and consumers are a large portion of the economy. So that would only contribute to the slowdown. Will T-bills be available? I think you might see a spike in the volatility, around the bills that are maturing around that time period of when we would hit the debt ceiling. And there's other things to consider. I mean, how do you price a bond that's still out there, that hasn't been, the principal hasn't been paid out and it's past maturity? There's weird things like that. There's just a lot of uncertainty around securities that may be maturing right around when we might hit a debt ceiling.
I will say, I mean, obviously this is kind of unknown territory, right? This has not happened before, but given some of the polarization right now in Washington, with both sides being extremely stubborn, something could happen. I have had a number of clients as rates have been increasing, and then also over the last couple of weeks here with the diversification ideas, I have a number of customers that are using an overnight investment sweep product, and those investments are short-term government and treasury funds. And to David's point, they're all like 30-day, 45-day maturities or less. My take on it is if it looks like there could be a default, I probably will be calling my clients and asking them to turn off or suspend those overnight sweeps until we know what's going on in the market, just because it's an unknown at this point. And frankly, I think it's their money is safer in the bank deposit than it is, in the overnight investment, just in case they can't get it out right away. So liquidity is the issue. I think, it's not, I think the government will eventually straighten it out and they'll all get their money out. But, if a customer is sweeping most of their operating cash into those overnight investments and they don't have that available the next day, even if it's for a day or two, that could be a significant impact on their business, especially if they have payroll and things like that. So, as we get closer here and as if things continue to look dire, I'll be calling my clients and telling them to suspend their sweeps for a couple of weeks probably.
Right. We had a handful of different questions about legislation, whether Glass-Steagall would be revisited. I mean, other things of that nature. I think really exploring the banking system. And when we were comparing or contrasting to 2008, for instance, I think one of the important distinctions here for people that want to philosophize about the economy and banking industry, large money center banks that are global entities represent a substantial part of the marketplace in the United States and in the world. And they represent not only great services, but real material and systemic risk to society, right? The kinds of banks that are state chartered or, larger regional banks, on their own don't represent the same kind, at least, of systemic risk to the economy. And what's happening in this period has to do more with those smaller banks and their ability to respond to changing interest rate environments and other circumstances, as Eric spoke to earlier, relative to management expertise. So in my view, the question was whether I think Glass-Steagall will be re-legislated. I don't think in the near term that that's something that's going to happen. I think, to me, the wisdom is protect more depositors as opposed to try to stop more banks from failing. when it comes to those smaller banks, relatively speaking. Even Silicon Valley, that's not a systemic risk to society. It's really more the fear about contagion that's caused this to be an issue. It's not not as if it sort of really matters to the markets if it wouldn't be this question of fear, right? Unlike, say, the big 4 or 5 or 8 banks in the United States or the world, that entirely different ball game. So I don't know if any other comments on that. Will major bank legislation be revisited? Oh, I'm sure it will be, and it's being discussed. Outside of increasing FDIC insurance limits, or there are other things you think that might be changed in the next few months or years? Eric or David, or other comments on this?
No, that's kind of out of my wheelhouse.
I think, there was significant changes made after 2008, 2009, 2010. In 2018, they rolled back some of that a little bit, but I don't believe that, some legislators were saying, well, Silicon Valley failed because we rolled back, some of those regulations in 2018. I don't know that is necessarily a wholly true statement. I don't know that the legislation that's in place today is necessarily insufficient. Banks and regulators have made some significant strides in beefing up their balance sheets, and frankly, to your point, Leighton, the larger they are, the more scrutiny, the more regulation they have, and the more restrictions, frankly, they have kind of on their capital base, et cetera. So the kind of that too big to fail structure is really pretty well developed, and regulators don't, they're making sure that the biggest of the biggest banks in the country are in a position so they're never gonna fail. They're diversified enough, and it's as you get downstream to some of the smaller institutions, and frankly, if a smaller institution fails, it's much easier for the FDIC and local regulators to manage that. So.
Well, maybe lastly, as to what will happen and other trends we're seeing, I would just add, just building off, I think what we've already said, that we don't have any particular indications of contagion or whatever you want to call it. One of the things you can look at is just how much liquidity from the Feds being tapped by banks. That's begun to dampen a bit. That's decreasing. So in other words, banks themselves are less afraid, which is probably a good sign. The Fed's still got a real needle to thread there relative to managing economic downturn while also managing inflation and not wounding a slightly fragile banking environment. So you heard David say the punchline of that is 25 basis points. And so, that's our best thinking, or as you said, David, what the market's telling us, right? Predictive futures are.
And that's what our economists are saying too, 25 basis points yet to go.
So that's what we see coming there. You've maybe gone from winter, spring pull back to maybe more like summer, fall pull back in the overall economy. So the tougher times are a little sooner than we thought, is the general notion. And beyond that, what else would you add, gentlemen? What other things do you see coming? What other things as a business owner would you want to know, or your comments about?
I guess the only thing I would just add is, some of our economists and investment folks are still very, very bullish on the American economy. I think they view recession as, a definite possibility, but more than likely fairly shallow, fairly quick. I guess we're all hoping for that. And so I think, from as I think about it from a commercial banking standpoint, I know our credit folks are looking at management teams of businesses. How are they managing their business? How have they managed their business through the last couple of cycles? And if you're doing the right things and having success, I think more banks are going to still be good partners for you. And I think getting through the last couple of years has probably been one of the bigger challenges you'll ever face. So,
David, any last words from you?
No, I think that sums it up.
Well, thank you. I would just say, maybe I'll cherry pick out. There was another question here. What's the long-term potential for United States businesses? I'll just only speak. This is as this whole call has been, a matter of personal opinion as opposed to professional guarantee from our institutions. But I continue to be very bullish on these United States, and these things come and go. The banking system at large, I think the interconnected nature of the banking system and how that's changed in its relationship to markets based on securitization of things and back to the 2008 and so forth, the world keeps getting more complicated. But the banking system we have in the United States is a very strong one. I mean, it's among the strongest in the world, and in many ways the envy of the world. The biggest picture to me is that in this country, when you have an idea and want to make something of it, you have the ability to access capital. And as much or more than anywhere in the world, and I'm proud of that and thankful for that to live here. And as a depositor, you have a substantial amount of resources that are insured and backed by the federal government. So, I mean, beyond that, speculating as to the future of the United States government and so forth, I'll stop short of that. But no, I'm as bullish on the long term, and I would just invite us all to remember also, without wanting to diminish the pain that has to do with interest rate changes, we are still at historic lows of interest rates, even in my lifetime. And I'm sure there are many people on the call who've lived more life than I have. So these 4s and 5s and 6s we'll see. My father were on the call. He'd remind me of what he paid for his first farm in the 80s, which was a whole hell of a lot more than that. So I think there's plenty to have poise about. We know there's some challenging times to come in the economy, as there always will be, ups and downs. I think the point about the points that we're asking about deposits and what to do with them, there is basic blocking and tackling for people to do to take advantage of the insurances that are made available by the federal government. And banks absolutely across the board are all hands on deck to be proactive in conversation with you. So I will say this: if you haven't had healthy, active conversation with your bank, and if they're not responding intentionally to this, answering your questions, helping to make sure you're well positioned, then you probably should look at options. But banks are open for business.
Excellent point. Yeah, you should be talking to your banker. So
yeah, so
and they should be talking to you.
Go ahead, Eric.
Yeah, no, I was just saying your banker should be talking to you as well. So
yeah, for sure, for sure. So with all that being said, thank you everyone for joining. Bethany, let me turn it back over to you for important housekeeping matters, and we'll conclude the call.
Great, thank you. Thanks again, Leighton, David, and Eric, for your time and your wisdom today. Just a reminder for everyone, we will be sending out a recording of today's session if you need to reference, or feel free to pass that along. Just share the word. We also will be sending out a short survey just to see how we did, but you can also answer put in any follow-up questions that you might have, so the team could follow up with you afterwards as well. But with that, we'll conclude today's session, and thank you all for joining.